Hello fellow option traders, this is Jeff, and as promised, today is March 4th of 2015, and in the daily scan that I did this morning, I sort of promised, or at least hinted around, that I would be interested in this long-term bear play, where I would do a bear call way out. In this case, we're looking at January of next year for expiration. And I was wondering if, you're counting on the market pulling back or declining 5%, 10%, 20%, whatever, maybe 50%, I don't know. What would be better to do? A bear call, credit spread, or a bear put debit spread? Okay, so I did a little bit of testing here, and I will just want to qualify this, and that these are all of the numbers that I come up with here are based on this Jerkson-Stensland calculation method that Thinkorswim platform uses for projecting volatility and prices out into the future. So this is just a theoretical model, but I thought that what else do I have to go on? I really don't have anything else to go on right now. So if the market is going to be pulling back, there's a couple things that I want to think about here. So first of all, based on a January expiration, what price would I be looking at? Well, there is a chart that I have here of the SPX, which is where we're going to be playing this. And I have these price levels here. I'm going to remove those. Those are from this morning, I think. So I'm going to take that off. So looking at January, here's the end of 2015. This is January of 2016. Provided the current trend continues, what would be safe? Well, I picked this 23.50 strike as my short strike for the credit spread. And then when I did the debit spread, I just looked for strikes that would give me the same break even. So here's what I came up with. 23.50 is my short on the credit spread, and 23.75, which is the next available strike, which is $25 away, which is... You have to have kind of a hefty account to handle that. That would be $2,500 taken out of your account or held aside and, for that. So you have to keep that in mind. Didn't have any other choices here because that's just the way it is. When you're that far out and that high up, your spread between the available strikes is $25. Sorry about that, folks, but that's just the way it is. Okay, back to the risk profile. Okay, so, all right, so if I wanted to do a debit spread, I would have to do puts, and my long would be at 23.75, similar to this, and my short would be at 23.50, similar to that. And by golly, this just works out absolutely perfect. So my debit here is $21.35. So I'd have to put up $2,135 in order to buy this spread. But if I did a credit spread, I would get a credit of $3.65 or $365. But Thinkorswim would hold back or take away out of my trading pot this $21.35 that's down here on the debit spread anyway. So either way, the money's unavailable, I guess you could say. Okay, so and what happens here is this is the way I set this up when I did it. First of all, there's this little coggy wheel over here. If you click on that, you get a part here, a row where you can change the volatility or the stock price or the yield. I don't ever mess with yield. All I'm going to do is be messing with this volatility, and we'll be messing with the dates. So I can push this date out here as far as I want. And I picked, let's see, 4 different dates to take a look at this. And what we're going to be looking at is, we're going to be looking at the price of the stock dropping 5% or 10%, or the price of SPX dropping 5 and 10%, and we're going to be increasing volatility from 0 to 5 to 10 and to 15%. Now that's not increasing it to 15%. That's increasing this number down here 15%. You're adding 15 to this number. I'm not increasing this number by 5 or 10 or 15%. I'm actually adding 5, 10, or 15% to this number. So that's just the way that this works here, and it makes it easier for everybody all around, I think. All right, let's take a look at the risk graph for the very first one. The way that I set this up was I went here and I said, okay, I'm going to want to do a percent here. So I want 5%. So now we have 5% a price slice and a 10% price slice. I'm going to move this one to, I don't know which one here I get break even on. Which one do I get break even on? Let's see here. Add slice, delete slice, row count. Set slices to break even on 115. Okay, so first thing we want to do is I want to show you that both of these have exactly the same break even. They both have the same risk reward. The risk reward, go take a look at my notes here. On the credit spread, the credit is $3.65 and the risk is $2,135. Same thing down here. Your risk is what you're paying for it, $2,135, and your reward is the same thing, $3.65. So it just so happens to work out that way. So here's the break even at 23.51.61. Let me turn this one off and turn this one on, and still 23.51.61 is the break even for this one as well. Okay, so now we are going to add a slice, and we want percentage, and we want a minus 5%, and then we'll right click and add another slice and change that to percent and pick minus 10%. Alright, so you're seeing right now, today, this is your baseline, I guess you might say. If today, by some magical thing, the price of SPX dropped 5% or 10%, and the IV did not change, your trade would be at 120. You would have $120 in profit at 5% and $268 at 10%. So, and then I went through here and I said, all right, let's take a look at next month, and we'll pick next month for the 6th. I'm not going to go through all this. It's a very tedious thing to go through here, but what I'm going to do is I'm going to show you a spreadsheet that I filled out with all the numbers, so you guys don't actually have to do it, to show you the difference between a credit and a debit spread. Now, the reason why I did this was because I was thinking that, well, gee, you know, if you're long, which you are in a debit spread, and IV increases, shouldn't that be an advantage? Whereas if you're short, and which you are in a debit or a credit spread, would not your value of your spread as price moves around decrease? Well, I had to prove this to myself, and I thought that maybe the debit spread would fare better than the credit spread, but it turns out that the credit spread actually performs just a tad bit better. How about that for a surprise? So the good part is, for me, since I'm a credit spread kind of person, I don't have to think backwards with a debit spread and do the same thing only with a debit spread. I don't have to do that. The only other question is, when things go bad, if something goes in the money or whatever, it's like, these puts here on this debit spread are in the money. And that's what kind of worries me a little bit about the debit spread. The credit spread, though, the calls are pretty far out of the money. So that's the only thing that kind of would, bother me a little bit. And you can see that here if you go to the simulated trades. You can see that these are very far in the money, and we have a delta of like in the 80s on these, so they're almost doing a 1-for-1 move, the stock to the price of the strike. So that's of interest, but the only thing here is the scary part is that they are in the money. So SPX, American or European? American or European? Weeklies, I think, are European. So it's probably not a worry on SPX, but it would be a worry, definitely, on equities, for sure. Okay, so let's not confuse things, though. Let's go back to this risk profile. So what I did then was I moved out, here we have moved out to April 6th, and I took a look at 0% and where our profit would be here for the 5% and the 10%. And then I just double-click this and type 5 and enter. And I just increased IV by 5%, and you can see that that had quite an effect on the P&L for the 5 and 10%. And then, same thing, double-click and enter. And then you can see what it does here, and then 15%. So it has, IV has a big effect, even though it's moving in your direction. Here is sort of proof that you're taking a hit on it, even though it's moving in your direction. Because generally, as a rule, when price drops, IV is increasing, or is going to increase, or already has increased, or something. But it's going to go up. So when the market goes down, volatility increases. So volatility here, the VIX is up 50 cents here today because the market's down. So VIX is climbing up. 14 is not very high. The VIX is the volatility, the S&P 500, which is this SPX, is the cash index for the S&P 500. So we're all in line here. Everything's all in sync. So I went through here and I did all of this. And here's what I came up with. Okay, so here we have the dates, April, May, June, and November. I went way out to November. And here's the IV change. Here's like our benchmark here is today, those numbers that I told you before. I took the pennies off and I rounded everything appropriately, either up or down, depending on whether it was above or below the 50-cent mark. So here's our benchmark. All right, so when we went to April, the part of interest here is the credit and the debit. Which one's doing the best here at a 5% drop in price and a 10% drop in price? So here we have, just as an example, here we have a 10% increase in IV and a 5% drop in price. And on the 6th of April, you'll be $202 in the hole for the credit spread. And on the debit spread, you'd be $208 in the hole. Not a whole heck of a lot of difference there, is there? Definitely not enough to really mean anything. If anything, the credit spread performs slightly better. And the same thing if price drops 10% and IV increases 10%. We have 16 and 22 credit to debit. Same thing here. When we get to May, and if there's no change in IV and price moves like this, here's where you're going to be for your P&L. You'll be ahead nicely, but possibly price could be down 5% and there would not be a change in IV if it's slow enough. And it could be just like a sudden pullback or something of 5%, because you can see, well, 5%'s a lot. If you look over here on a daily basis, 0.5%'s a big move. And I've said that for quite a while. Normally it's 0.25%, like we have here on the NASDAQ futures and on the Russell futures. But here on the S&P and the Dow, well, the Dow's over 0.5%, and the S&P is very close to 0.5%. So those are sort of big moves for a day. And if it moves 0.5% a day, maybe over a week or two period, it could drop 5% for sure, and not change IV very much at all. So that's a possibility. But, to be fair, we just kept everything the same, and we retested all those. And no matter where you look here, the difference between the credit and the debit is negligible from a P&L perspective, in my mind anyway. So we got 326 and 322. Okay, so what's the difference? When you go way out to November, this is 2 months before the January expiration, doesn't have too much of a effect at all, the change in IV up to 5%, but once you get up to 10%, then things start changing a little bit more. But still, comparing the credit to the debit, not a whole heck of a lot of difference, if you see what I mean. So, what's the conclusion? Well, I'm just going to keep on doing credit spreads and just forget about this whole thing about debit spreads. Using the formula here on the Thinkorswim platform and not actually tracking this day by day is the only thing that I can do. And I think it's relatively accurate. I haven't known it to be inaccurate, but the same numbers are being applied to both. The same formula. So that's the way it is. So again, in conclusion, keep on going with the credit spreads unless somebody tells me something different or can prove something to me. I think I proved it to myself here that there really is no difference. So I just keep on going. Now, I will be posting this on my blog with a little bit more detail, the detail information on what the spreads are and everything else, just to let you know. So that should be about it. Hope you enjoyed this. Thanks a heap for watching. Have a great day and happy trading.